Hey, what's up, Clobear fam? Thank you so much for coming back to my channel. Today we are going to be talking about index funds. I'll talk about what they are, why I like them, and how to start investing in them. I'll also talk about some of the downsides of investing in index funds. But before we get right to it, be sure to hit the like button and be sure to hit subscribe because the YouTube algorithm needs it. Algorithm's really hard to say. Now, before we get talking about index funds and investing, I do want to remind you that I am not a certified financial planner, so I cannot tell you what funds to start investing in. I can only teach you about them and explain which ones I like and why I like them. So if you do have questions, you can see a certified financial planner or do the research yourself, but these are just my thoughts on it. So even though this video is about index funds, this is my disclaimer. I am not a CFP. I am just somebody on the internet who knows a little bit about money and likes to share what she learns. Okay, so now that we have those two very important things out of the way, you've already hit the like button, you've already hit subscribe, and you already know that I am not a CFP. Let's talk about index funds. What is an index fund? So an index fund is a type of mutual fund that is passively managed. It is designed to follow an index, like the S&P 500. It has within it every stock or bond or whatever is in the S&P 500. It's got a little bit of each of those stocks and bonds within the fund. Now, while all index funds are mutual funds, not all mutual funds are index funds. Similar to mutual funds, index funds take a pool of money from investors like you and me in order to create a portfolio of financial assets. So that can be stocks, it can be bonds, it can be other different securities, but essentially when you purchase one index fund, you are purchasing a portfolio that has shares of many different companies and many different financial assets. So try to think of it like a box of chocolates versus a chocolate bar. So if you are purchasing a chocolate bar, you're buying one thing. You're buying a financial asset, you're buying a stock, you're buying a bond. When you purchase a box of chocolate, you're purchasing the whole box. So inside of that box, you've got a little bit of bonds, you've got a little bit of stocks, you've got a little bit of everything in all these different companies. So you've got Amazon, you've got Apple, you've got Google, all the different things inside of the box. You can't buy just one stock from the index fund. You have to buy the index fund as a whole. So like I said, if you purchase an S&P 500 index fund, that index fund is going to have every single financial security, stock, bond, whatever within it that is in the S&P 500. It's nice, this is a benefit to the investor because as an individual investor, if you were to buy every single stock or bond in the S&P 500, it would cost you thousands and thousands and thousands of dollars. Whereas if you purchase an index fund, while they're a little bit more expensive than buying an individual stock a lot of the times, it's still just one price and it's a lot cheaper. Now, because the index funds are designed to perform according to an index like the S&P 500, there's not a lot of buying, selling, trading happening in the index fund, which actually makes it a lot cheaper for you to purchase and keep rather than an actively managed mutual fund in which some guy is purchasing, selling assets every single day in order to make as much money as possible for the investor. These funds are designed to be the market instead of beating the market, which a lot of actively managed mutual funds are designed to try and beat the market. So the whole point of a mutual fund is to beat the market so that they can make as much money as possible for the investors, while an index fund is just designed, in a way it's kind of like lazy investing, it's just designed to perform according to the market. So what the market does that year, the index fund is going to do what that market does that year. Now, because it's passively managed and it's designed by a computer, an algorithm, or they only have to set it up once really to mirror the index, index funds are a lot less expensive to hold than mutual funds. The thing about mutual funds that makes them so expensive is that you have to hire a professional to manage that mutual fund. And those mutual funds, they're managed by people who are top of their class, graduated from Ivy League schools, and they are constantly going in, buying and selling in order to make you a profit. Index funds, you don't have some Brad managing your account, so you don't have to pay for the salary of somebody who is managing your fund. Now, mutual funds can often have an expense ratio of 1 to 3%. Index funds, a lot of times their expense ratios can be as low as 3 to 0.03% or 0.05%. Now, that might not sound like a lot, but it makes a huge difference when you're talking about hundreds of thousands of dollars and sometimes even millions of dollars. For example, if you have $500,000 invested into a mutual fund that has an expense ratio of 3%, that means you are spending $15,000 a year to hold that mutual fund. Now let's say you have $500,000 invested in an index fund with an expense ratio of 0.05%. That means you're looking at an annual fee of only $2,500 in comparison to $15,000. The kicker is you pay those mutual fund fees, that 3%, that $15,000 every year, even if the mutual fund manager loses money for you. Can you imagine paying someone to lose money for you? I can't, which is why I prefer index funds. At the end of the day, index funds over the long term outperform these actively managed mutual funds that are also super expensive. Money is made within an index fund the same way that money is made in a mutual fund, either from buying and selling index funds, capital gains that are made when the values of the assets within it are going up in value. Oh, Logan wants to come in and talk about personal finance. But they also have dividends, which are basically like a thank you note that you get from the company for buying and holding a stock or an investment. Now, let's talk about the benefits of owning an index fund. First, diversification. So unlike purchasing an individual stock or bond, a mutual fund or an index fund has a ton of diversification because when you purchase one fund, you're buying the whole box of chocolate rather than just one piece of chocolate. Why do people care about diversification? Well, it makes the investment less risky. When you only purchase one stock, you are completely putting all of your eggs in one stock, meaning if the company fails, all your eggs are failed with it. If the company succeeds, all your eggs are succeeding with it. The egg analogy feels weird now. With an index fund, you've got 100 different stocks or bonds, sometimes even more than that, in one fund. So if one company bottoms out, you still have a bunch of other companies to kind of cushion that blow. Another benefit of an index fund that we've already really touched on is that they're really low cost. Like I said earlier, a lot of their times their expense ratios are between 0%, as in free 99, to 0.05%. Another reason I love index funds is they outperform actively managed mutual funds time and time again in the long term. Just look at the last 15 years. 92% of index funds have outperformed actively managed mutual funds. So that means that even though people are spending money on having their funds actively managed, most of the time index funds are outperforming these actively managed expensive mutual funds. If you look at the short term, the numbers are a little bit different, and a lot of the times mutual funds can outperform index funds, but when you're looking at the long-term strategy, index funds are the way to go. Another reason I really like index funds is because they're just easy. I don't have to spend every day looking at the stock market and wondering when the best time is to buy and sell. Ultimately, all I do is I buy and I hold, and I don't ever have to think about it again. I buy a lot of index funds in my 401k, and once a year I'll look at the 401k to rebalance it, but for the most part, it kind of just works itself out. When you look at index funds and you look at the stock market as a whole, index funds that are designed to mirror the entire stock market are often looking at an average of 7 to 8% returns. Index funds are such a powerful tool for building wealth that even investor Warren Buffett hedged a bet against hedge fund investors in order to see what would outperform the market, their actively managed funds or one index fund that mirrored the S&P 500. After 10 years, Warren Buffett won. Warren's choice of investment was a Vanguard S&P 500 index fund that compounded annually 7.1%. His competition, these actively managed funds, their average returns were 2.2% annually. And if you're anything like me, I don't want to spend tons and tons of time worrying about the stock market, checking the market every day to see how my stocks are performing, and trying to understand in time when I'm supposed to pull out. Instead, I just want to buy it and I want to let it grow, and that's what index funds are. It's pretty great. Buying index funds are really easy too because pretty much every financial institution has index funds. So if you go to Fidelity and you search Fidelity index funds, they'll have an entire list of index funds for you to purchase or look into, and they'll show you what the fees are associated with each. The cool thing about Fidelity too is Fidelity has multiple zero-cost index funds. This video is not like sponsored by Fidelity or anything, but every financial institution, brokerage has them. So if you're in Charles Schwab, look up Charles Schwab, I said that totally wrong. Look up their index funds, look at Vanguard's index funds, look at Fidelity's index funds, and you will find something that is what you're interested in. Now, while I'm a diehard index fund fan, there are obviously a few drawbacks, just like there are with every type of investment. Now, they aren't flexible. So when you purchase an index fund, like I said earlier, you have to buy that whole box of chocolate. So if there's a company in there that you don't want to own, well, you kind of have to if you want to purchase that one index fund, or if there's some kind of changing around you want to do within the fund, that's not something you can do, and you just have to buy it as a whole. And similar to what I said earlier, there are limited gains for an index fund. They are not designed to beat the market and make you rich really quickly. Instead, they're just designed to mirror the market, which on average over the last 100 years is between 7 and 8% when adjusted for inflation. Another downside of index funds is that often they are very expensive to get into. So a lot of index funds, they cost thousands of dollars in order to get started. You need an initial investment, and that can be expensive and can be a barrier. So you have to spend some time saving up in order to start investing. All right, now I know what you guys are all thinking. Well, Clover, this sounds great. How do I start investing in index funds? And it's simple. Whether you use Ellevest or Robinhood or Fidelity or Vanguard, whatever financial brokerage that you're working with, they will have index funds. So most of the time I recommend you only buy index funds through the same brokerage who put it together. So don't buy a Vanguard stock on Ellevest or don't buy a Vanguard stock on Fidelity. Stick to the index funds that are offered by that entity, because a lot of the times if you purchase something from Vanguard on Fidelity, you're going to have unnecessary costs involved rather than just opening a free account and investing that way. Index funds generally are very easy to find because they have the word index in the title. So do your research beforehand, but check out whatever financial institution you're investing with, make sure that they have some index funds, and then pick out some small caps, some medium, some large caps. You can do a total market index fund. You can do so many different kinds, but just check out the different options and see what's best for you in terms of the kind of exposure that you want. Let me just also take a moment to note that if you are wary of investing and you are scared about investing, I hope you know that I've been there and I was also on the same page. I always kind of just figured like, oh, I'll just, I'll figure it out eventually, or, I'm just not gonna be the type of person who invests, so I'll do my 401k and I'll have them balance it for me and it'll be fine, it'll all just work out. Totally get where you're coming from, but I promise you investing in index funds is so easy and the performance speaks for itself. So don't just click off immediately. Take a second to learn about it, because I think you'll be surprised on just how easy it is to invest in index funds and get pretty decent returns by doing that. Ultimately, index funds are my favorite way of investing, but they're just one way of investing. So you have to spend some time thinking about what kind of investor do I want to be? Do I want to get really into it, read up on these companies and try to time the market, even though most people can't time the market. If the hedge funds that are managed by Ivy League graduates are failing 92% of the time over the long term, the chances of you, average Joe, beating the market is probably pretty slim. But if that's something you're into, hey, I'm not gonna yuck your yum. But there's so many different ways to invest. So index funds are just one of the ways. It's my favorite way because it's the least risky and it's also so chill. I don't have to worry about it and I just get to put my money in there and just keep doing it. There is also obviously real estate investing, there's day trading, there's cryptocurrency, there's so many different ways. You just have to figure out what the right way is for you. So that is all I've got for you today on index funds. If you are into investing, put your favorite type of investing down in the comments below, because I'd love to see what other people are doing. But if you have questions too, put those in the comments and I'll be sure to get back to you. So thank you so much for watching as always. I hope to put out a couple more videos specifically focused on investing, and if this is the kind of content you like, be sure to hit the like button and be sure to hit subscribe. So thanks for stopping by, and I'll see you guys next week.